Background: the business of exchanges, a crash course. Part 5: exchange options. OTC markets, over-the-counter markets. I mentioned OTC markets briefly when talking about exchanges, but how are they different? Imagine you want to buy a rare antique book. You could go to an organized auction with strict rules and verification procedures. This would be an exchange. The alternative OTC market is you find the watch through a network of specialized dealers or who operate outside of formal auction houses, perhaps a Facebook marketplace, eBay. Over-the-counter transactions occur directly between market participants, hence the name, over-the-counter, which invokes the image of a transaction happening across a merchant's counter rather than through an exchange's trading floor or an electronic system. For example, we're running a small business and you want to sell a small stake. If you are not on a public exchange, you can tell your brokers that you're willing to sell at $50, and they will try to find a bureau buyer. This transaction would occur over the counter. The OTC landscape. The OTC markets encompass a vast, diverse universe of securities, stocks, typically for smaller companies that either don't meet the requirements for major exchange or those who are listed outside the country, following different regulatory standards and don't want to duplicate their requirements, bonds, derivative, currencies, commodities. OTC market tiers and players. In the United States, the OTC markets are dominated by OTC Market Group, and they run their markets in their tier system. Their primary tier, OTCQX, the highest tier, with the most stringent requirements. Companies here must meet financial standards, follow best practices, corporate governance, be current in their disclosures, and have professional third-party sponsors. International companies from representative foreign exchanges often use this tier for U.S. listings. OTCQB, the middle tier, known as the benchmark. Companies here must be current in reporting, undergo annual verifications, and meet a minimum bid price test. This tier typically includes early-stage and developing companies. And then the pink open market. You may have heard the pink sheet stocks or penny stocks. These trade here. This tier is the most basic and minimal requirements to enable trading. Penny stocks aren't the only thing you would find here. In pink open markets, you will find everything from solid foreign companies to opt for limited U.S. disclosure to speculative distress or shell companies. Companies categorized under 4 categories, with current information, limited information, or no information, based on their disclosure practices. Expert market, a designated for securities that can only be viewed by broker-dealers for certain institutional investors, not available to the general public. This usually includes delisted companies, companies with limited information, or securities of companies that are going through bankruptcy proceedings. Gray markets, securities that trade over the counter but aren't quoted by broker dealers or any over the counter market platforms. This trade with the least transparency. Key players in over the counter markets include market makers, brokers, over the counter market group, the one I mentioned in the United States, FINRA, the Financial Industry Regulatory Authority, which oversees broker-dealer operators in the over-the-counter markets, and the transfer agents, who keep the records of ownerships. The regulatory environment. The regulatory environment of the over-the-counter markets varies drastically by country. In the United States, over-the-counter markets are regulated primarily through broker-dealers who participate in them, rather than through direct regulation of the markets themselves. Key regulations include SEC Rule 15C211. This rule requires broker-dealers to review and maintain a certain minimum information about an over-the-counter security before publishing quotations. This requirement forces the publicity of the company's recent financial statements, business description, and insider information, or any regulatory filings they have filed. This ruling also includes the information to be regularly updated. The rule was dramatically strengthened in 2021 to enhance investor protection. Regulation SHO governs short selling, borrowing an asset to sell with the hope it will be cheaper to buy back in the future, with special provision for over-the-counter securities. Rules include requiring broker-dealers to either borrow the securities or have high confidence they can do so at a later date, and take the risk of borrowing a security if the client can't recoup the loan. Blue sky loans, state-level securities that provide additional investor protections, and FINRA rules. And there are extensive regulations that govern the broker-dealers who are actually participating in the over-the-counter markets. The SEC doesn't directly regulate over-the-counter markets as an exchange, but rather as an ATS, alternative trading system. We'll talk more about these in a bit, which has different typical and less stringent requirements. Canada's approach to over-the-counter markets differs significantly from the US Canada runs secondary exchanges such as TMX Group's TSX Venture Exchange, TSXV. That brings smaller companies under regulated exchange than if they were in the United States, who would trade in the over-the-counter. Canada has generally more rigorous continuous disclosure obligations than the United States counterparts and stricter requirements to list. The regulatory body that oversees these requirements is the Canadian Securities Administration, the CSA, which works together with provincial security regulators to coordinate their over-the-counter trading. For securities that don't qualify for secondary exchanges, have the option to be traded over the Canadian Unlisted Board, CNCX. In Europe, there are formulated over-the-counter markets, and the approach is very similar to North America. They have, for example, multilateral trading facilities, MTFs, that have formalized over-the-counter markets as under their MIFID regulations. They have systemized internalizers. They're the broker-dealers who systematically internalize clients must go to register with CIs and follow specific transparency requirement. And they have major reforms that change the rules and keep it in a structured market practice. Risk and benefits of over-the-counter markets. Over-the-counter markets present unique characteristics that can either be advantageous or disadvantageous depending on your perspective. The environment provides access to capital for small companies at a lower cost and gives them the small companies to grow rather than being rushed to publicly trade on an exchange. The downside is that for investors, there's very limited transparency. There's a greater risk of fraud and generally not enough information to base your assumptions. Furthermore, with the company being smaller, you can't always buy or sell. You sometimes have to wait for a buyer or seller to emerge. The paradox also stems that regulating these markets is extremely difficult. Too much regulation can stringent capital formation for small businesses and limit investment opportunities. Too little can expose investors to excess risk and undermine market integrity. Different countries have chosen different points for the spectrum. The United States system provides relatively easy access with tiered information requirements. Canada has opted for more formalized ventures markets with stronger regulation. The EU also has formalized structure for what would otherwise be over-the-counter trading. As Warren Buffett might say, in over-the-counter markets, its lack of a lifeguard doesn't mean you can't swim, but it does mean you need to be a stronger swimmer to pay closer attention to potential hazards. For savvy investors, these markets can offer opportunities not available elsewhere. For unprepared investors, this can be treacherous waters indeed. Dark pools. Exchanges offer you a way to buy the best and biggest. Over-the-counter encapsulates the smaller companies and more complex contracts. So it seems like we are done. We don't need anything else. However, not quite. Both of these venues are missing a feature that big players are willing to risk price stability and certainty for execution. The desired feature is more clearly observed in a farmer market. Think of an exchange as a place where buyers and sellers meet openly, haggle over the prices, and everyone can see who is buying and at what price. But imagine if, behind these market buildings, there's a separate area where large restaurants buyers could purchase entire truckloads of produce without announcing their intentions or revealing their price to the general public. That's essentially the desired feature. The ability to anonymously sell very big chunks of securities with no intermediate disclosure, and also the stability of not influencing real-time prices. This is essentially the function of dark pools. Dark pools are a major component of global trading, and surprisingly to many, they account for a substantial portion of all stocks trading in the United States. By some estimates, over half, which means over 50% of all stocks trade volume now takes place off exchanges, with dark pools being a significant component of alternative trading system ecosystem, which is where these trades are routed. But what are these dark pools? Dark pools in their basic format are private exchange-like venues that are run in collaboration with big financial firms that offer off-exchange transactions for large trades discreetly. This can be operated independently as an ATS. Again, we'll talk about them in a bit. And you may be wondering why dark pools are called dark pools in the first place. Exchanges, or called lit venues, are public places where everyone can see the order book, the pending buy and sell orders. In contrast, dark pools are dark, which means that information about the orders is hidden until the trades are complete. This means there is no pre-trade information available at all to when participants place their orders. The name itself, dark pools, sounds a little ominous, like something from a financial thriller or a hidden secret known only to market manipulators. However, dark pools weren't created for nefarious reasons, although they have been misused. They were developed to solve the legitimate problem for certain market participants, particularly large institutional investors. Why do they exist? Imagine you're managing a pension fund and need to sell 10 million shares of a company. If you place that order in the New York Stock Exchange, several things would likely happen. The markets would see your massive order and immediately bid the price down. You'll end up getting progressively worse prices as the order is executed. You might even trigger a broader market reaction based on speculation about why you're selling. This is what traders refer to market impact. The phenomenal act of placing a large order itself affect the market price. It's like trying to sell your house without letting your neighbors know you're desperate to move. Dark pools address this issue by enabling large blocks of shares to be traded privately. Pension funds can find a buyer without advertising its intention to the whole market, potentially getting a better price and avoiding market disruption. How do they work? In practical terms, let's look how the dark pool transaction might unfold. An institutional investor sends an order to a dark pool. A dark pool matches this order with another participant's order at the midpoint of the current public bid and ask price. The trade executes without a pre-trade transparency. Other market participants don't see the pending orders. After execution, the trade is reported to consolidate market data feeds, but with a delay without identifying the parties that were involved. Dark pools typically use one of the several matching methods: price, time, priority, similar to public exchanges; size priority, larger orders will get the preference; or participant type priority, certain categories of traders get preference. Types of dark pools. Not all dark pools are created equal. They generally fall into three categories. There is broker-dealer owned, which means that large investment banks like Goldman Sachs, which has Sigma X, Morgan Stanley, MS Pool, UBS, ATS, operate their own dark pools primarily for their clients. Exchange-owned dark pools, like for example, New York Stock Exchange has the NYC Euronext Liquidnet, have their own dark pools to compete with the broker-type dealer pools. And independent pools. Companies like Liquidnet and ITG operates independent dark pools to aim to connect buyers and sellers without potential conflicts of broker-dealer pools. There is regulatory differences around the world. Dark pools operate under different regulatory frameworks than public exchanges, but these frameworks vary significantly from one country to another. Let's look at how this plays out in different countries. So you're already familiar with the US. Let's look at Canada. Canada takes a different approach to dark pools through UMIR, which means Universal Market Integrity Rules Framework, which means that public markets are executed first. So unlike the US, Canada requires that public lit exchanges get priority. Dark pools in Canada only get the leftovers. They can only execute orders after visible marketplace participants have had their chance. This last say approach is fundamentally the difference between the US model and the Canadian. There's price improvement requirements. Canada Dark Pool must provide meaningful price improvements over the visible markets to execute trades. Typical requirements: execution at the midpoint of the national based bid and offer. Size threshold. There's a minimum size requirement for certain dark pool orders in Canada, meaning small retail size orders often must be executed on lit markets. High reporting standards. Canada's dark pool face more stringent and frequent reporting requirements than their United States counterparts. The stricter requirements have resulted in dark pools having much less market share in Canada, typically less than 10% of total volume, compared to the Americans' 50%. The Canadian approach deliberately preserves primacy of public markets. Let's look at Europe. The EU MIFID's second regulation introduced even stricter controls over dark pool tradings, including volume caps, which means that dark pools trading is limited to percentage of total trading volume, minimal transparency size, similar to Canada, saying that dark pools are for larger blocks, and they have systemized internalized framework, creating a new category for broker-dealers matching their client orders. These differences regulatory approaches reflect varying philosophies about market structure. The United States has generally favored competition and innovation, even if it means fragmentation in their marketplaces. Canada has prioritized price discovery from function of public markets, while the EU has perhaps taken a stricter approach, explicitly limiting dark pool trading. Controversies and concerns. As you may have read this, you may have been wondering why isn't it too easy to take advantage of the system. The critics will agree with you. Some worry about conflicts of interest where broker-dealers who operate these dark pools might prioritize themselves over other participants. Others worry about the fairness question, making sure that everyone gets treated the same and not large institutions gaining priority in the marketplace. The nature of darkness in these dark pools have had the future of limiting transparency, liquidity, and unknown complications rising concerns how it would function in a marketplace meltdown. Moreover, there are reportedly high-frequency traders that have ways to exploit these dark pools' activity, somewhat undermining the original purpose of these marketplaces were intended for, and gaining an advantage over other market participants. So what's the balancing act? Like so many financial innovation, dark pools represent a trade-off. They solve a real problem for certain marketplace participants while creating a potential significant concerns for market structures and fairness. What's undeniable in their significance. Such a large portion of trades now happening away from public exchanges, understanding dark pools isn't just for financial insiders, it's essential knowledge for anyone who wants to comprehend how modern markets function. ATSs, Alternative Trading Systems. Throughout this letter, you may have noticed my mentioning of ATS, Alternative Trading Systems. For example, the section above about dark pools, which are a subset of ATS. Unlike other sections, ATS umbrella of venues that operate with less regulatory shackles are the main competitors directly to an exchange. At its core, their functions are the same, matching buyers and sellers. However, the ATS system has a lot more flexibility in its operation and different customers than an exchange. Alternative trading systems are, in essence, private marketplaces that match buyers and sellers' securities without being registered as formal exchanges. Think of the difference between a supermarket, which would be the New York Stock Exchange, the Toronto Stock Exchange, the Tokyo Stock Exchange, etc., and a private subscription produce service that connects local farmers directly to customers. This would be an ATS. Both provide fresh produce, but they operate under different rules and serve different needs. In the United States, ATS are regulated as broker-dealers under the regulatory ATS rather than an exchange. This distinction gives them more flexibility in how they structure their operations and how they allow participants to join their marketplace. There are different types of ATSs. One you've met, which are the dark pool, but the others are electronic communication networks, also called ECNs, and they're probably the closest direct competitors to an exchange. If an exchange is a regulated farmer market, an ECN is an online marketplace that automatically matches orders based on price time priority. They're transparent about their available orders. Imagine a digital bullet board where farmers and customers see the buys and sell offers. However, they need to pay to get in, and you only see limited information, such as the current best price someone is willing to sell or buy. They're crossing networks. So these are very similar to darknets, and some people can even use them interchangeably. But they have a distinct difference, is that they always execute a transaction at the midpoint of the best bid and ask. A farmer's market equivalent, this would be going to a store and price matching. Furthermore, crossing networks usually are internal systems for matching between a broker's internal clients and not routing to exchanges. Then there's block trading venues, specialized systems for very large transactions, typically over 10,000 shares. Now, farmers markets analogy, these would be specialized wholesalers who handle truckloads rather than individual baskets. Rise of ATS, challenging the exchange monopoly. Alternative venues have grown dramatically in recent years. By 2023, as I've mentioned throughout the letter, is that more than 50% of U.S. equity trading volume occur away from public exchanges. This remarkable shift prompted many to ask, is this the end of traditional exchanges? If ATS are so prominent and similar, why keep public exchanges at all? If I agree on a price, can I just stop using the exchange? And is this why you stumble on why ATS cannot fully replace public exchanges? Because of two limitations: market transparency and regulations. The transparency paradox. The very feature that makes dark pools, block venues, and crossing networks so attractive to institutional investors is the ability to trade without revealing their intentions in the market. Trading without moving the market price anonymously to get in and out of positions, creating a significant problem. If most trades moved to non-transparent venues, how would the market discover fair prices? Think about it. If most farmers had customers negotiate privately deals behind closed doors, how would anyone know the fair price to tomatoes in the public market? How would you know that you aren't being taken advantage of? The public price discovery mechanism would break down. This isn't just a theoretical or moral requirement. It's a practical systemic requirement for many institutional investors. For example, pension funds managers have a regulatory obligation to demonstrate that they're achieving the best execution for their trades. How ATSs actually work and how they make their money. ATSs are very similar to exchanges, but they do have certain distinctions that differentiate them from exchanges. You may have noticed I've been constantly highlighting their less regulatory rules and the main power that allows them to build differently. For example, ATS typically have multiple different order mechanisms instead of a central book. An ATS might match you based on time, order size, client's name, etc. Another distinction is ATS have no requirements to let anyone in, meaning an ATS can choose who trades on their exchanges and can cater to specific clientele, creating a moral question of if some investor loses access to certain assets. Is this fair? Also, over-the-counter ATSs have the freedom to be located anywhere, leveraging their location, for example, to sell real estate for high-frequency traders close to their exchange to execute quicker. How can they make money? They have transaction fees. The primary revenue source is they charge per transaction on their venue. They have subscription fees. Some charge regular access fees to participants or for certain order limits per day or per month. They sell their data. They're less competitive than exchange data. Some over the ATSs sell their trading data. And they have technology service. Many offer additional services like custom algorithms or specialized trading interfaces, or, as mentioned, leasing space to get closer to their servers. Importantly, many ATSs are operated by broker-dealers and may also be trading on their own platform, creating potential conflicts of interest that regulators continue to scrutinize. Global variations. ATSs around the globe can take different shapes and sizes. In Canada, the difference between the United States is limited, with some ATSs competing directly to the TSX. In the EU, similar venues operate, such as the Multilateral Trading Facilities, MTFs, under the Market and Financial Instrument Directive, MIFID. European regulations have generally pushed for more transparency than the United States rules, but a lot of similar incentives and structures appear in their system. In Asia, there's slow adaptation of ATSs, with countries like Japan having priority trading systems and Hong Kong and Singapore maintaining more centralized markets. The future balance, coexistence rather than replacement. Should we panic or seek opportunities to switch to ATSs, then exchanges are going to prove redundant? The dramatic growth of ATSs raises legitimate questions about the future of traditional markets. However, the markets have evolved towards a balanced ecosystem where they both play an important role. Today, even though 50% of trades happen in ATSs, the total volume of trades is growing. And the only reason ATS rise is that exchange as a business are phenomenal, and there are players coming to take a piece of their pie. However, public exchanges provide essential transparency and price discovery that benefit all market participants. Without them, even the ATS's functions would lack reliable reference points for prices for their own transactions, not to mention that most depend on public information to make their markets. Meanwhile, ATS provide valuable services for specific needs, particularly for large institutional traders who might move market prices on public exchanges. They also pressure traditional exchanges to become more efficient, innovative, and cost-efficient, making sure they don't push their limits as regulated monopolies. Lower-tier exchanges. Think of stock exchanges like a sport league in European soccer or football. Just as you have the Premier League at the top and the Championship one level below in England, the financial world has a similar tiered structure of its markets. The major exchanges like the Toronto Stock Exchange or London Stock Exchange sit at the top tier, with stringent listing requirement, hefty fees, and global visibility. But what about the promising small company in Saskatchewan that's generated $5 million in revenue, or the innovative startup in Wales that's developing a new technology that hasn't turned a profit yet? These companies need capital too, but they can't meet those steep requirements of the premier exchanges. That's why the lower tier exchanges come in. They're the Championship, League 1, League 2 of the financial world. AIM, Alternative Investment Market, AIM. London Stock Exchange, AIM, launched in 1995. It's perhaps the most successful second-tier market in the world. It is designed specifically for smaller growing companies that need access to public capital but can't yet qualify for the main markets. What makes AIM different? For starters, there's no minimum market capitalization requirements. A company doesn't need a trading history, and it doesn't need a minimum percentage of shares in public hands. Instead of the exchange setting rigid rules, each company works with a nominated advisor, or nomad, who gives them through the listing process of votes for their sustainability. This approach has made AIM a magnet for growth companies. A company like ASOS, an online fashion retailer, listed on AIM when it was valued at just £12 million, eventually growing to billions of market cap while still trading on AIM in junior leagues before you can move to the major leagues. As you can imagine, this flexibility comes with a higher risk. AIM companies have a higher failure rate than those in the main markets, LSX. When shopping for stocks in AIM, they're often looking in their business, still proving their model, not established blue chips with decades of dividends behind them. The TSX Venture Exchange. Across the Atlantic to Canada, you'll find the TSX Venture Exchange, formerly the Canadian Venture Exchange, which operates under a similar principle as AIM, but with its own Canadian flavor. Like in so many parts of the world, Canada used to have multiple exchanges across the nation. Each city would find its niche where it would specialize. Without getting into the finer details, in Canada, the Vancouver Stock Exchange played a crucial role in the development of smaller mining and oil companies that morphed into today's importance for the resource sector under the TSX Venture Fund. Think of a small mining company that's identified a promising mineral deposit in northern Ontario, but needs capital for exploration. They're years away from producing revenue, let alone profit. The main Toronto Stock Exchange would turn them away, but the TSX Venture offers them a path to public capital. The exchange uses the tier system within itself. Tier 1 is for more established companies with stronger financial, Tier 2 for earlier stage ventures with more modest requirements. This creates a natural progression where successful Tier 2 companies will move to Tier 1 and eventually graduate to the main TSX. In a typical year, dozens of companies make their journey from junior to senior exchanges, showcasing how these lower tier markets serve as an efficient incubator for growing businesses. Euronext Growth and other European juniors. In Europe, beyond AIM, there's Euronext Growth, formerly Ultranext, which serves similar companies across multiple European countries, including France, Belgium, Portugal, and Ireland. Like its counterparts, Euronext Growth has lighter regulatory requirements than their main Euronext market. Companies need only 2.5 million euros in market capitalization compared to 60 million on main markets, and can list with just 2 years of financial statements instead of 3. Other European countries have their own versions. Germany has Scale, Italy has AIM Italia, Spain has GME Growth, all designated with similar purposes in mind. Thank you.